Hi, my name is Carla Carderera. I am one of the managing partners at Upfront CPA. And I wanted to record this video because lately we have been receiving a lot of questions from clients asking about the new Trump accounts. It's been all over the news. It's very brand new. So everybody's asking, what are they? Is it a tax saving for me? How can I use it? How can I open one? So that's why I wanted to record this video real quick to give you some information directly from the IRS website. So as an accountant, you can see if there are any tax benefits to you for opening these accounts or not and how they work. So again, I want to cite the IRS website directly to make sure that if you do decide to open one of these accounts and you do qualify or your children do qualify, that you have clarity on what it does and how it can help you, if it can help you or your child. So, number one, the Trump accounts are legally treated as a new IRA or as a new traditional IRA. So they are a new type of individual retirement account for eligible children. It is important because it tells us how Congress intended these accounts to be taxed. Now, there is no deduction for contributions. Section 530A of the Internal Revenue Code specifically provides that contributions to Trump accounts are not deductible. Therefore, if a parent contributes if you do decide to open one of these accounts and you as a parent contribute $5,000 to that account, it is not deductible for you as the parent. It's going to be deposited there, and that account is going to be invested and it's going to grow. So they do not receive a tax deduction. It does not reduce taxable income, and it does not reduce your adjusted gross income. So this is one of the misconceptions I have heard. Again, people see this all over the news, so they don't necessarily look for more in-depth information about it. And again, this is not deductible for a parent if they contribute to one of these Trump accounts. So the tax benefit is tax deferred growth. So again, the IRS explains this exactly. Contributions grow inside the account without annual taxation. In general, the money cannot be withdrawn before the child turns 18. And after that, the account is generally treated as a traditional IRA and follows many of the same tax rules. So that means that the investment earnings are not taxed every year, allowing the account to compound over time. So that is a good thing. You can definitely do that. But again, you're not going to see a benefit as a person or as a parent contributing to this account today. But the child is beneficial for a child because they're going to have an account that is going to hopefully keep growing, and then they're going to be able to use it differently after they turn 18. They can use it as an IRA at that time. So the question that everybody asks about, the $1,000 government contribution is not taxable. And again, not every child qualifies for this $1,000 government contribution. You have to be born between January 1st, 2025 and December 31st, 2028 in order to be able to qualify for this $1,000 contribution for the government. So the IRS guidance also provides that the government's initial contribution under the pilot program is not included in the child's gross income when it is deposited. Now, here's another good question regarding what about if the grandparent, for example, wants to contribute to this account. Let's talk about the gift tax guidance. One area that the IRS generally clarified is the gift tax reporting. So Revenue Procedure 2026-2025 provides a safe harbor so that many contributions by family members will not require gift tax reporting, provided by the stated requirements are met. So making sure that if the requirements are met, these do not qualify for gift tax reporting purposes. Therefore, from a tax planning standpoint, I would not market these accounts as a tax saving strategy. Again, do not think of the Trump accounts as a strategy to save money in taxes. Instead, you have to think about that the primary benefit isn't an immediate tax deduction. The real value is receiving the government's $1,000 contribution to those that do qualify and allowing the investment to grow tax deferred over many years. That's a much more accurate statement under the IRS guidance. And again, this is something to look at for long term. It's an investment that you're making for your child at this moment. And although it's not going to give you a tax benefit, it's at this time for you personally as a parent, again, it is going to give a benefit to your child when he's older or when he or she are older. So again, make sure that you look into more information before you decide whether you want to open this account. Make sure that you have the cash flow, obviously, to be able to fund it. And also contact a financial advisor. They are the ones that will actually set up this account for you and go over this process, because that's something that they are the experts on as far as how to open the account and how to manage it. Again, on the tax side, for us as an accounting firm, again, it's not part of the tax planning. It's not a part of the tax planning. This is just an investment that you're currently making for your child. And again, to qualify for the $1,000 from the government, you have to be born between January 1st, 2025 through December 31st, 2028 in order to be able to receive that $1,000 from the government. I hope this helps. Thank you very much. I'll see you next time.